Everyone keeps asking the same question: when will the recession start? But what if that question is already wrong? Because what we're living through right now isn't a recession. It's the phase before one, Harshe, and historically, this is the most dangerous moment. Nothing is breaking yet. And that's exactly why you should be paying attention. Right now, the economy looks fine. Stocks are near highs, unemployment is still low, inflation is no longer exploding across headlines. And that's the problem, because historically, the most dangerous economic phase is not the crash itself. It's the period before the crash, when the numbers stabilize, but the system quietly weakens underneath. This is the phase where policymakers say things like soft landing, where analysts talk about resilience, where the public starts to relax again. But if you look at past collapses, this calm phase shows up every single time. Before 2008, markets rallied for months while credit was already breaking. Before 2000, stocks hit new highs even as profits collapsed. Before 1929, the economy appeared strong, right up until it wasn't. The pattern is consistent. When nothing is visibly breaking, that's when risk is actually highest, because during this phase, leverage builds, bad debt hides, and structural damage spreads silently. What we're in right now is not recovery, it's compression. And compression doesn't release gently. Most people think recessions follow a simple script: growth slows, jobs disappear, markets fall, panic sets in. That's not what's happening now. What makes this moment dangerous is that the traditional warning signs are out of sync. Economic data says one thing, lived reality says another. GDP is still growing, but productivity is falling. Corporate earnings look stable, but only because costs are being delayed, not solved. Employment numbers look strong, but job mobility has collapsed. People aren't moving to better jobs, they're clinging to the ones they have. This isn't expansion. It's stagnation with good optics. Historically, this kind of environment only appears when an economy has reached the limits of what monetary policy can paper over. Interest rates are no longer stimulating growth, they're restraining collapse. Debt isn't fueling expansion, it's preventing defaults from surfacing. Liquidity isn't creating innovation, it's keeping weak structures alive. That's why everything feels heavy. Small businesses aren't investing, consumers are spending, but only by draining savings or using credit. Corporations are reporting profits while quietly cutting future capacity. This is not a cycle resetting, this is a system stretching, and systems don't stretch forever. They either rebalance or they snap. What's especially dangerous is that during this phase, decision makers lose urgency, markets normalize dysfunction, governments delay hard choices, investors assume time will fix what structure cannot. But history shows the opposite. When growth slows without clearing bad debt, when prices stay high while real incomes stagnate, when confidence is maintained artificially, the eventual adjustment becomes sharper, faster, and more destructive. This phase is not about decline, yet it's about pressure building where no one wants to look. And the longer it lasts, the worse the release becomes. The most dangerous part of this phase is not weakness, it's apparent stability. Markets are calm enough to feel safe. Institutions are functional enough to seem reliable. Everyday life continues just enough to convince people that nothing is fundamentally wrong, but this is how systemic risk hides. Stability today is being manufactured, not earned. Asset prices are supported by expectation, not cash flow. Governments are financing deficits by rolling debt forward, not reducing it. Central banks are signaling confidence because admitting fragility would accelerate panic. This creates a feedback loop. As long as nothing breaks, everyone assumes nothing will. As long as markets don't crash, risk is reclassified as manageable. As long as people are employed, the system is assumed to be healthy. But beneath the surface, the buffers are disappearing. Household savings rates are back near historic lows. Credit card balances are rising at double-digit rates. Corporate refinancing cliffs are approaching as cheap debt expires. Commercial real estate valuations are quietly resetting downward without headlines. These aren't shocks, they're stress fractures. And stress fractures don't announce themselves. They propagate quietly until one small force causes a sudden collapse. This is why comparisons to past recessions are misleading. In 2008, the system broke because leverage snapped. In 2000, it broke because valuations collapsed. In 1929, it broke because credit evaporated. Today, none of those have fully happened yet. Instead, we have something more unstable, a system that cannot move forward but is being prevented from moving backward. Prices can't fall without triggering defaults. Rates can't rise without breaking governments. Rates can't fall without reigniting inflation. Every lever is locked. That's not balance, that's paralysis. And paralysis always precedes force. When systems lose flexibility, they don't adjust gradually. They hold until they fail suddenly. This is the phase where leaders tell you patience is required, where experts say the economy is resilient, where markets drift sideways while risk concentrates. But resilience isn't the absence of failure, it's the ability to absorb shock. Right now, the global economy is absorbing stress by borrowing time, and time eventually runs out. A recession is a release valve. This is not. In a normal recession, excess is flushed out, bad investments fail, debt is written off, prices reset. Pain is sharp, but it has a direction. What we are in now has no direction. Losses are not being realized, they are being postponed. Risk is not being removed. It is being redistributed and hidden. This is why this phase is more dangerous than an outright downturn. Recessions clear systems. This phase pressurizes them. Zombie companies continue operating not because they are viable, but because failure would expose larger fragilities. Banks extend loans they know won't be repaid on schedule. Governments subsidize sectors that no longer generate real productivity. Markets price assets as if future growth is guaranteed, because acknowledging otherwise would collapse confidence. Nothing is allowed to fail. And when failure is forbidden, fragility compounds. Debt doesn't disappear when growth slows, it becomes heavier. Every year of delayed adjustment increases the scale of the eventual correction. Every artificial stabilization raises the floor temporarily, while hollowing out the foundation underneath. This is how slow-motion crises form. They feel boring, they feel manageable, they feel technical, until suddenly they aren't. The danger is not a single event, it's accumulation. Each refinancing cycle pulls future returns into the present. Each bailout converts private risk into public obligation. Each intervention narrows the margin for error. Eventually something breaks not because it was large, but because there is no room left to absorb it. At that point, the narrative changes overnight. What was described as temporary weakness becomes systemic stress. What was contained becomes contagion. What was unlikely becomes inevitable. This is why history never collapses during panic. It collapses during complacency. Right now, the system is telling you it's stable enough, not strong, not healthy, just stable enough to delay decisions. That is the most expensive form of stability there is, because when adjustment finally comes, it doesn't negotiate. It arrives all at once. Every major collapse has a trigger. But here's the mistake most people make. They look for the cause. There is no single cause. There's only the moment the system runs out of tolerance. Right now, that tolerance is being quietly eroded in places that don't make headlines. Not stocks, not crypto, not even housing. The real pressure is building in credit. Credit is the bloodstream of the modern economy. When it flows freely, everything appears alive. When it tightens, even profitable businesses suffocate. And credit is tightening, slowly, unevenly, and mostly off camera. Banks aren't collapsing, they're becoming defensive. Lending standards are rising, loan durations are shortening, collateral requirements are increasing. Refinancing is no longer automatic. This doesn't feel like a crisis, it feels like friction. But friction is how systems fail. Companies that relied on cheap refinancing are discovering that rolling debt forward now costs real money. Households that survived inflation by using credit are hitting limits. Governments are absorbing more risk precisely when their own balance sheets are deteriorating. This is not a liquidity shock yet, it's a refinancing trap. Debt taken on during zero-rate years is maturing into a world where capital has a price again, and not everyone can pay it. The danger is timing. Defaults don't arrive evenly, they cluster. One sector misses expectations, one regional bank marks losses, one large borrower fails to refinance quietly, then risk models update, spreads widen, capital retreats. That's when nothing is wrong becomes why is nobody bidding. This is why the most dangerous triggers are not dramatic events, they are process failures. A bond auction that clears weekly, a treasury issuance that requires intervention, a credit market that opens but only at punitive terms. By the time this shows up in headlines, the mechanism is already running. And here's the part nobody likes to hear. Central banks can slow this process. They cannot reverse it without consequences. Lower rates revive inflation. Higher rates accelerate defaults. There is no neutral move anymore. The system is no longer balancing risk. It is choosing where the damage lands, and that means the trigger won't look like a crash. It will look like a decision, a choice to protect one side of the system and let the other absorb the shock. History shows what happens next. Not immediately, not explosively, but inevitably. Here's why most people will miss what's coming. This phase does not feel like danger. It feels like normalization. Inflation cools, but prices don't fall. Jobs remain, but mobility disappears. Markets rise, but only for a narrow group of assets. On paper, the system looks stable. In reality, it's becoming rigid. Healthy systems absorb shocks by flexing. Unhealthy systems absorb shocks by transferring stress. That's what's happening now. Instead of collapsing, the economy is redistributing pressure from governments to households, from households to credit, from credit to weaker institutions, from weaker institutions to policy decisions. Nothing breaks all at once. Everything tightens simultaneously. This is why people keep saying, I don't see the crisis, because this isn't a crash environment. It's a constraint environment. Opportunities narrow, mistakes become permanent. Margins for error vanish. In past recessions, you lost income. In this phase, you lose options. You can still work, but changing jobs costs you. You can still borrow, but only at rates that trap you. You can still invest, but liquidity matters more than returns. This is how systems prepare for failure without announcing it. And here's the psychological trap. When nothing dramatic happens, people assume nothing serious is happening. They wait for a signal that never arrives. But structural breakdowns don't announce themselves. They emerge. By the time layoffs spike, the credit contraction is already done. By the time markets fall broadly, positioning is already locked. By the time policy reacts aggressively, credibility is already damaged. This is why the phrase soft landing is so dangerous. It implies control. But what's actually happening is managed deterioration. Decision makers aren't trying to prevent damage anymore. They're trying to sequence it. Slow enough to avoid panic, contained enough to avoid blame, spread out enough that no single event looks responsible. That works until it doesn't. Because systems don't fail from stress alone. They fail when stress meets rigidity. And rigidity is exactly what this phase creates. The longer this drags on, the less flexible the system becomes. The fewer exits remain, the more violent the adjustment when it finally comes. That's why this phase is worse than a recession. A recession clears excess, this phase locks it in. And once it's locked in, the only way out is through something much harder. When this phase finally breaks, it won't be because of the thing dominating headlines. That's the mistake people always make. They wait for a single obvious cause. A stock market crash, a major bank failure, a geopolitical shock, a sudden spike in unemployment. But in systems like this, the trigger is almost never the center of attention. It's usually something peripheral, something that exposes how fragile everything already is. In 2008, it wasn't housing prices falling that broke the system. It was interbank trust collapsing. Banks didn't fail because homes lost value. They failed because no one knew who was solvent anymore. In 2020, it wasn't the virus itself that caused panic. It was the realization that supply chains had no redundancy. Today's system has its own hidden fault lines. They don't live in stock indexes. They live in places most people don't track. Commercial real estate refinancing, shadow banking liquidity, sovereign debt rollover risk, energy and commodity bottlenecks, political limits on policy responses. The danger isn't one of these breaking. The danger is two breaking at the same time. This system can survive almost any single shock. What it cannot survive is correlation. When pressure points start moving together, the illusion of stability disappears instantly. And here's the critical insight. By the time a trigger is obvious, it's already too late to react. Markets don't collapse because of surprises. They collapse because everyone realizes at once that there is no clean exit. Liquidity dries up not from fear but from math. Risk premiums rise not from panic but from repricing reality. Institutions pull back not because they want to, but because they must. This is when narratives flip. Yesterday's resilient economy becomes today's unexpected shock. Yesterday's contained risk becomes today's systemic concern. Yesterday's temporary slowdown becomes today's structural problem. And the speed of that flip is what destroys unprepared systems. This phase conditions people to believe stability is normal. That's why the reversal feels violent. It's not that conditions change overnight, it's that perception catches up all at once. That's the moment when policy loses control. Interest rates no longer calm markets, stimulus no longer reassures households, statements no longer restore confidence, because credibility is the first thing spent in slow-moving crises. Once it's gone, tools stop working. And here's the most uncomfortable part: the longer this not a recession phase lasts, the more likely the eventual trigger becomes political, not financial. At some point, someone has to choose who absorbs the pain. Households, banks, investors, governments. Those choices create winners and losers. And when systems reach that point, stability ends. Every economic cycle reaches a moment when numbers stop mattering, not because the data disappears, but because decisions stop being driven by it. That moment is when politics replaces economics. Up until now, the system has been managed technocratically. Central banks adjust rates, governments tweak budgets, markets price risk incrementally. But this phase doesn't end with a spreadsheet. It ends with choices. Who gets protected? Who absorbs losses? Who gets bailed out and who doesn't? Those are not economic decisions, they're political ones. And once politics takes over, predictability collapses. History shows this pattern clearly. In the 1970s, inflation wasn't defeated because policymakers didn't understand economics. It persisted because tightening policy was politically unbearable. In 2008, the crisis didn't end when losses appeared. It ended when governments decided which institutions would survive. In Europe after 2010, the debt crisis wasn't about math. It was about whether voters would tolerate austerity. Today, we are approaching that same boundary. Rates are already high enough to break things. Debt levels are already too large to sustain them. Inflation is already politically toxic. There is no pain-free option left. Cut rates and inflation re-accelerates. Hold rates and defaults spread. Raise taxes and growth collapses. Cut spending and social pressure explodes. Every lever now carries a cost that someone will feel directly. And when that happens, economic management turns into narrative management. Leaders stop asking, what stabilizes the system? They start asking, what can we survive politically? That's when policies become inconsistent. That's when signals get mixed. That's when credibility erodes, because markets don't just price numbers. They price belief. Belief that rules will hold, belief that contracts will be honored, belief that policy has a plan beyond the next election. Once that belief weakens, volatility increases even if the data looks stable. And here's the key insight most people miss. This phase doesn't feel like collapse, it feels like frustration. Nothing works the way it used to. Every fix creates a new problem. Every announcement calms markets briefly, then fades. People sense something is wrong but can't name it. Trust erodes quietly, participation declines, risk tolerance vanishes. This is the phase where capital stops taking chances, where businesses stop expanding, where households stop planning long-term. Not because they're afraid, but because the future stops feeling legible. And once the future becomes unclear, systems stall. That's when pressure builds, that's when delays accumulate, that's when the next block in the chain starts to strain. Every system can absorb stress, right up until the moment it can't. That moment is not announced. There is no headline that says confidence has broken. It happens quietly. One auction clears weaker than expected. One bank quietly tightens lending. One currency moves a little too fast. Individually, these events mean nothing. Together, they signal a shift. This is the point where markets stop asking, is this a slowdown? And start asking, who's exposed? Liquidity doesn't vanish all at once. It retreats, risk premiums rise, credit spreads widen, capital pulls back to what feels safest, and suddenly activities that relied on smooth financing, refinancing debt, rolling loans, funding growth, become fragile. This is where the system reveals what was only implied before. Zombie companies don't fail because demand collapses. They fail because funding disappears. Commercial real estate doesn't implode because offices empty overnight. It implodes because refinancing no longer works. Banks don't collapse because assets instantly go to zero. They collapse because confidence in balance sheets erodes. Confidence is the invisible asset everything depends on, and it's asymmetric. It takes years to build, it can break in weeks. Once confidence fractures, behavior changes faster than policy can respond. Investors demand certainty instead of yield. Banks prioritize survival over lending. Consumers delay spending without knowing why. This is the phase where volatility spikes without obvious cause. Markets swing on rumors, narratives change weekly. Every data point is interpreted through fear, and crucially, trust in forward guidance disappears. When central banks speak, markets listen, briefly, then they fade the message, because credibility depends on control. And control is no longer visible. At this stage, intervention still works, but only temporarily. Liquidity injections calm markets for days, emergency measures by weeks, but each intervention confirms the same truth. The system needs support to function. That realization changes everything. Because once participants believe a system is being held together, they stop treating it as stable. They treat it as conditional, and conditional systems don't attract long-term commitment. They attract short-term positioning. That's when the game changes. The market stops being a place to invest, it becomes a place to survive. And once that shift happens, the final phase is no longer about economics at all. It's about reaction. Crashes are visible. This phase is not. That's what makes it more dangerous. In a traditional crisis, things break loudly, markets fall fast, fear is obvious, responses are decisive. But what we're living through now is different. This is a slow erosion phase where systems still function, but only barely. Where numbers look acceptable, but the behavior changes underneath. And behavior is what matters. One day, when companies stop hiring, even though profits exist, when banks stop lending, even though capital ratios look fine, when consumers feel poorer, even as unemployment stays low. That's not a recession signal. That's a trust signal. The system is no longer trusted to deliver tomorrow what it delivered yesterday. This is the phase where mistakes compound. Policy responses arrive late because the damage isn't obvious yet. Markets misprice risk because historical models don't apply. Institutions hesitate because no one wants to be the first to admit weakness. And during this hesitation, fragility grows. Debt that looked manageable becomes unmanageable without warning. Liquidity that felt abundant disappears in specific corners first. Stress concentrates silently in places no one is watching closely enough. This is why the most violent collapses in history didn't begin at the peak. They began after long periods of stability. The Great Depression followed the new era optimism of the 1920s. The 2008 crisis followed years of calm, predictable growth. Every major breakdown was preceded by confidence, not fear. We're back in that zone, where danger isn't obvious enough to force change, but severe enough to make the system unstable. And here's the final uncomfortable truth. The longer this phase lasts, the more extreme the eventual adjustment becomes. Because imbalances don't dissolve quietly, they accumulate. And when correction finally arrives, it doesn't ask permission. This isn't about predicting the exact trigger. It's about recognizing the stage. A stage where resilience is overstated, where narratives lag reality, where comfort becomes the enemy. The most dangerous moments in economic history aren't when people panic. They're when people say, nothing's broken yet. That's the phase before something worse. Nothing in this video required belief, only pattern recognition. Every system gives signals before it breaks, not warnings, signals. They appear when things still function, when data looks stable, when leaders say there's no reason to worry. The real risk isn't collapse, it's waiting until collapse makes decisions for you. The next phase won't announce itself. It never does. It reveals itself only in hindsight, after positioning becomes impossible and reactions replace preparation. This channel exists to document these phases before they're renamed in history books. Not to predict panic, but to understand structure. What happens next depends on whether this phase ends quietly or violently. That's what we'll examine next.